The market has a habit of hiding the most important opportunities in the places that look too small to matter. Not in the companies already on magazine covers. Not in the stocks everyone on social media is arguing about. Not in the names that already feel obvious. The real signal often shows up earlier, when the story still looks messy, when the financials are not clean, when the stock chart scares away impatient investors, and when the company sits in that uncomfortable zone between speculation and strategic importance. That is where this $17 stock becomes interesting. Not because a low share price means it is cheap. That is one of the most dangerous mistakes investors make. A $17 stock can be expensive. A $500 stock can be cheap. Price alone tells you almost nothing. What matters is the pressure building underneath the price. What matters is whether the market is looking at a company as a small speculative stock, while governments, defense budgets, space programs, and strategic capital are starting to treat the same company as infrastructure. And that difference matters, because the next decade may not reward the same companies that dominated the last decade. The last cycle was built on software, cloud, advertising, consumer platforms, zero interest rates, and cheap capital. The next cycle may be built on something much harder to replicate: energy, defense, space, autonomy, AI infrastructure, sovereign supply chains, and the companies that can physically build the hardware layer of that world may be far more important than the market currently understands. This is where most investors get trapped. They look at the stock market as a popularity contest. They chase the name that has already moved. They wait for perfect earnings. They wait for analysts to agree. They wait for the story to become safe. But by the time a frontier market looks safe, the asymmetric part of the opportunity may already be gone. The question is not whether this stock is guaranteed to work. It is not. The question is whether the market is still pricing it like a small, risky space company, while the world around it is quietly moving toward a future where space and defense are no longer separate industries. That is the contradiction. And contradictions are where the best investors pay attention. For years, space investing was treated like science fiction. Retail investors were sold dreams about Mars, rockets, satellites, moon bases, and trillion-dollar futures. Most of those dreams did not turn into profits. Some companies went public too early. Some were more presentation than business. Some depended on endless capital. Some promised a future that might be real one day, but had no real path to survive until that day arrived. So the market became skeptical. And honestly, it had good reason. When interest rates rose, the entire speculative space trade was punished. Anything without strong cash flow was thrown out. Anything that required patience was sold. Anything connected to SPACs was treated as damaged goods. And that is the first reason this opportunity exists. Because the market often overcorrects. It does not simply punish weak companies. It throws strong possibilities into the same basket as weak stories. The crowd says, space stocks failed. But that is too simple. The better question is, which space companies were actually building critical infrastructure while everyone else was chasing headlines? That distinction is important, because space is no longer just about exploration. It is no longer just about billionaire rockets. It is becoming a military layer, a communications layer, an intelligence layer, an intelligence layer, and eventually an economic layer. And when an industry moves from dream to necessity, the valuation logic changes. A dream is valued on imagination. A necessity is valued on dependence. That is a very different thing. Think about what has happened over the last few years. Geopolitical tensions have forced governments to rethink supply chains. Wars have shown the importance of drones, satellite imaging, real-time data, resilient communications, and autonomous systems. AI has created a new demand for infrastructure that does not stop at data centers. Defense departments are not just buying tanks and aircraft anymore. They are buying software, sensors, satellites, low-cost autonomy, space-based systems, and platforms that can survive in contested environments. At the same time, private markets have become crowded with giants that ordinary investors cannot easily access. SpaceX is private. Anduril is private. Many of the most exciting defense technology companies are private. The best AI infrastructure companies are either already enormous or unavailable to public investors. So public market investors face a strange problem. They can see the future being built, but much of it is locked away. This is why a smaller public company sitting at the intersection of space infrastructure, autonomous systems, and defense technology deserves attention. Not blind enthusiasm. Attention. Because if the public market has only a few liquid ways to express a major theme, capital can crowd into those names very quickly once the narrative changes. That is how asymmetric setups are created. They begin in neglect. Then they move into recognition. Then they become consensus. And the largest price moves often happen between the first and second stage, not after the third. This is why Redwire is worth studying. Again, not because the stock price is low, not because the chart is clean, not because the business is risk-free. It is worth studying because the market may still be struggling to decide what this company really is. Is it a small space infrastructure company? Is it a defense technology company? Is it a drone and autonomy platform? Is it a government contractor? Is it a satellite system supplier? Is it a speculative growth stock? Or is it slowly becoming a multi-domain infrastructure business? At the exact moment, governments are being forced to spend more on the technologies it provides. That uncertainty is the opportunity, but it is also the risk. Because when a company is easy to categorize, Wall Street can model it cleanly. When it is difficult to categorize, Wall Street often discounts it. Investors do not like ambiguity. They prefer simple stories. A chip company sells chips. A bank lends money. A consumer platform sells ads. But a company that sits between space, defense, autonomy, solar arrays, sensors, robotics, manufacturing, drones, and national security does not fit neatly into a spreadsheet. And when something does not fit neatly, the market often underprices it until the numbers become too obvious to ignore. That is the hidden mechanism here. The market is not just pricing a stock. It is pricing confusion, and confusion can create opportunity when the underlying demand is becoming more certain. Look at the bigger picture. The world is not becoming safer. The global system is fragmented. The United States and its allies are rethinking industrial capacity. Europe is worming. The Middle East remains unstable. The Pacific is becoming more militarized. Supply chains are being pulled apart and rebuilt. And above all of this, space is becoming a strategic battlefield. Not necessarily in the dramatic way movies imagine it, but in a quieter, more important way. Satellites guide communications. Satellites support navigation. Satellites monitor troop movements. Satellites track weather, shipping, agriculture, missiles, and infrastructure. If a country loses access to space-based systems, its military and economy become more vulnerable. That means space infrastructure is not optional anymore. It is becoming part of national defense. And once something becomes part of national defense, budget cycles can become very different from ordinary consumer demand. A consumer can delay buying a new phone. A government facing strategic pressure may not have the same luxury. This does not mean every defense or space company will win. Many will not. Execution matters. Margins matter. Depth matters. Dilution matters. Contract quality matters. Management matters. But the demand environment is no longer based purely on imagination. That is the key shift. A decade ago, investors had to believe in a distant space economy. Today, they can see governments and defense customers demanding real capability right now. And that is why the old way of analyzing these companies may be incomplete. If you only look at trailing earnings, you may miss the contract pipeline. If you only look at current losses, you may miss operating leverage. If you only look at the stock chart, you may miss strategic repositioning. If you only look at SpaceX, you may miss the companies building the components, systems, and infrastructure around the entire ecosystem. The most obvious company is not always the best public market opportunity. Sometimes the best risk-reward sits in the supplier, the integrator, the overlooked infrastructure layer. During a gold rush, the emotional investor wants to own the mine. The more careful investor asks who sells the tools, who controls the logistics, who gets paid whether one explorer wins or another. That is the more interesting way to think about this, because the space economy will not be one company. It will be a supply chain, launch providers, satellite builders, solar power systems, sensors, communications, in-space manufacturing, autonomous aircraft, defense platforms, ground software, thermal systems, structures, mission support. The public imagination focuses on the rocket. But the rocket is only one part of the system. A space economy cannot scale without everything around it. That is where smaller infrastructure companies become important. They do not always get the attention first. They often do not have the cleanest numbers. But if they become embedded in critical programs, their value can change very quickly. This is also why the acquisition of edge autonomy mattered. A company that was once viewed primarily through the space infrastructure lens now has a much clearer connection to drones, uncrewed systems, and defense demand. That is not a small detail. It changes the market's mental model, because drones are not a futuristic story anymore. They are already reshaping modern conflict. They are cheaper than traditional platforms. They can be deployed quickly. They can gather intelligence, extend surveillance, and reduce risk to human operators. And governments are learning that mass, adaptability, and cost efficiency can matter as much as prestige hardware. This is one of the biggest defense lessons of the last few years. The world does not only need a few extremely expensive systems. It also needs distributed, replaceable, intelligent systems that can operate across air, land, sea, and space. That is the multi-domain theme. And if Redwire can position itself in that theme, the market may eventually stop valuing it like a niche space stock and start evaluating it as a defense technology platform. That re-rating is the real open question. A stock can rise because earnings rise, but a stock can also rise because investors change the category they place it in. That second kind of move can be powerful. When a company goes from speculative space spat to strategic defense technology infrastructure, the multiple investors are willing to pay can change. But this only happens if execution follows the story. That is why the numbers matter. Not just revenue, not just backlog, not just one contract headline. The important question is whether the company can convert demand into profitable growth without constantly needing outside capital. Because this is where many exciting companies fail. They have a real product. They have a real market. They even have real customers. But they cannot finance the journey without diluting shareholders or taking on too much risk. The business grows, but the per-share value does not. That is the trap. Retail investors often focus on the company's future and forget the capital structure. But in small-cap growth investing, the capital structure can decide everything. A great theme attached to a weak balance sheet can still hurt shareholders. A company can win contracts and still disappoint if margins are thin, integration costs rise, or cash burn remains too high. So the serious investor does not ask, "Is this a cool company?" That is not enough. The serious investor asks, "Can this company survive long enough, scale efficiently enough, and capture enough value from the theme to reward shareholders?" That is the only question that matters. And for Redwire, the answer is not obvious yet. That is why the opportunity exists. If the answer were obvious, the price would likely already reflect it. The market pays a discount for uncertainty. Sometimes that discount is justified. Sometimes it is excessive. Investing is the art of knowing the difference. Now step back and look at what is happening across the market. The biggest technology companies have become enormous. Leaders trade at valuations that already assume a great deal of future success. The magnificent winners of the last cycle are still strong businesses, but they are no longer hidden. Everyone knows them. Everyone owns them. Everyone has a model explaining why they can keep winning. That does not mean they will fail, but it does mean the easy discovery phase is over. When a company is already priced for excellence, the investor's margin for error shrinks. Small disappointments can create large drawdowns. Meanwhile, smaller companies connected to the next infrastructure cycle are still volatile, misunderstood, and underowned. That is where the asymmetry may be. Not safety, asymmetry. There is a difference. Safety means the downside is limited and the outcome is stable. Asymmetry means the downside is real, but the upside may be significantly larger if the thesis plays out. A $17 stock in an emerging defense and space infrastructure theme is not safe in the way a treasury bill is safe. It can fall, it can disappoint, it can dilute, it can miss estimates, it can be punished by higher rates. It can suffer if government contracts are delayed, but if the company executes, If the acquisition expands its market, if defense spending continues moving toward autonomy and space-based systems, and if public investors begin searching for liquid exposure to private market themes, the upside case can become much larger than the market initially assumed. That is the trade-off. And this is where investor psychology becomes crucial. Most investors say they want early opportunities, but early opportunities rarely feel comfortable. They come with incomplete information. They come with ugly quarters. They come with volatility. They come with critics. They come before the big institutions fully agree. By the time everyone agrees, the price usually looks very different. So the question is not, can we eliminate uncertainty? You cannot. The question is, are we being compensated for taking that uncertainty? That is a more mature framework. And it is especially important now because liquidity conditions are changing. The era of free money trained investors to chase stories without caring about cash flow. Then the rate shock punished that behavior. Now the market is entering a more complicated phase. Governments are running large deficits. Debt service costs are high. Central banks are under pressure. Defense budgets are rising. AI infrastructure requires enormous capital. Private markets are searching for exits, and public markets are being asked to absorb more and more stories at valuations that may or may not make sense. In that environment, capital becomes selective. It does not fund every dream equally. It flows toward themes that have urgency. And few themes have more urgency than national security, autonomous systems, and control of strategic infrastructure. This is why the defense angle matters so much. A pure space exploration story depends heavily on long-term vision. A defense technology story can be pulled forward by immediate need. That difference can shorten the timeline. And in investing, timeline changes valuation. Cash flows expected 20 years from now are worth much less than cash flows that could arrive in the next 3 to 5 years. If a company moves from distant optionality to near-term demand, the market may be forced to reprice. This is the part many investors miss. They focus on what the company is today, but the stock market prices what the company might become, discounted by uncertainty. If uncertainty falls while the opportunity grows, the stock can move aggressively. That does not require perfection. It requires a change in perception. The risk, of course, is that perception can move both ways. If the company misses expectations, if margins do not improve, if backlog does not convert, if integration becomes messy, or if investors lose patience, the same uncertainty that creates upside can create sharp downside. This is why position sizing matters. A serious thesis does not require reckless exposure. The goal is not to fall in love with a story. The goal is to understand the setup better than the crowd. And the setup here is not just about one company. It is about a market that may be misreading the next capital cycle. For the last decade, investors were rewarded for owning digital monopolies. The businesses were asset-light. Margins were extraordinary. Growth was global. Capital costs were low. That was the perfect environment for software and platforms. But the world being built now is more physical. AI requires power, chips, cooling, factories, and infrastructure. Defense requires production capacity. Space requires hardware. Energy security requires grids, fuel, storage, and materials. Supply chain security requires domestic manufacturing. This is not a purely digital cycle. It is an industrial technology cycle. And industrial technology cycles behave different. They are messier. They are more capital intensive. They depend on government policy. They involve contracts, manufacturing, working capital, and execution risk. But when they work, they can create durable strategic companies. The market is not fully comfortable with that yet. Many investors still want software margins from hardware businesses. They want clean profitability before scale. They want certainty before the government budgets arrive. They want a smooth chart in an industry that is still being formed. That mismatch creates volatility. But it can also create entry points for patient investors who understand the difference between temporary mess and permanent impairment. Temporary mess is when a company is integrating an acquisition, scaling production, improving margins, and absorbing growth costs. Permanent impairment is when the business model does not work. the product lacks demand, or shareholders are repeatedly diluted without progress. The hard part is knowing which one you are looking at. With Redwire, the bullish interpretation is that the company is building scale at the right time, in the right markets, with exposure to space infrastructure and defense autonomy, just as those categories become more important. The bearish interpretation is that the company is still small, still risky, still unprofitable, and still dependent on execution in markets where contract timing and capital needs can be unpredictable. Both views have merit. That is what makes the stock worth analyzing. If there were no bear case, there would be no discount. If there were no bull case, there would be no reason to care. The opportunity lives between those two views. Now consider the private market angle. SpaceX has become one of the most important private companies in the world. Anduril has become one of the most important private defense technology companies. OpenAI and other AI infrastructure players have shown how quickly capital can concentrate into strategic platforms. But ordinary public investors cannot easily buy most of these companies. So what happens when the public market starts looking for second-order exposure? It searches for adjacent names, suppliers, partners, competitors, infrastructure providers, public companies with similar strategic themes. This can create powerful flows. Sometimes those flows are rational. Sometimes they become speculative, but they are real. We have seen this before. When NVIDIA became the center of the AI trade, investors began searching for power companies, cooling companies, data center rights, semiconductor equipment names, networking companies, and even utility stocks connected to AI electricity demand. The first move was obvious. The second move was where investors began thinking deeper into the supply chain. The same thing could happen in space and defense. The first move is SpaceX, but SpaceX is private. So investors look at Rocket Lab. They look at satellite companies. They look at defense technology names. They look at component suppliers. They look at autonomy platforms. They look at anything that might benefit from the same capital cycle. That does not mean every adjacent stock deserves a premium, but it does mean scarce public exposure can become valuable. Scarcity matters. If there are only a handful of public ways to invest in a major strategic theme, those names can attract attention far beyond their current size. This is especially true if the company begins reporting numbers that confirm the story. A rising backlog, improving gross margins, larger contract wins, defense customer expansion, successful integration of acquisitions, reduced cash burn, stronger guidance. These are the signals that can turn a narrative into a re-rating. Without them, the story remains just a story. And stories alone are dangerous. That is why the next few quarters matter. Not because one quarter defines a company, it does not, but because early-stage re-ratings often depend on whether management can prove the business is moving from promise to execution. Investors will forgive volatility if they see direction. They will not forgive confusion forever. The company has to show that revenue growth is not being bought at any cost. It has to show that margins can improve. It has to show that acquisitions are not just larger numbers on a slide, but real strategic integration. It has to show that defense demand can translate into durable economics. And it has to show that shareholders are not simply funding an exciting future while someone else captures the value. That last point is critical. In emerging industries, employees, customers, suppliers, lenders, and insiders can all benefit before common shareholders do. A great company does not always equal a great stock. A great theme does not always equal a great investment. A great product does not always equal shareholder returns. The investor has to follow the value. Where does the money go? Who has pricing power? Who controls the customer relationship? Who owns the intellectual property? Who bears the cost overrun? Who gets diluted? Who captures the margin? These questions are not as exciting as talking about rockets and drones. But they are the questions that decide outcomes. And this is why a calm approach is required. The worst thing an investor can do with a stock like this is turn it into a religion. The second worst thing is dismiss it without doing the work. The right approach is to understand the thesis, define the risks, watch the signals, and avoid emotional decisions. Because volatility will come. In a stock like this, volatility is not an accident. It is part of the structure. Small cap growth, defense, headlines, space enthusiasm, contract uncertainty, rate sensitivity, acquisition risk, retail attention, institutional skepticism, all of that creates sharp moves in both directions. The stock can look brilliant one month and broken the next. That does not necessarily mean the thesis changed, but sometimes it does. The discipline is knowing what signal would actually invalidate the thesis. A price drop alone is not invalidation. A price spike alone is not confirmation. The real signals are business signals. Backlog quality, cash usage, margins, contract conversion, customer concentration, balance sheet health, integration progress, management credibility. If those improve, while the stock remains misunderstood, the opportunity may strengthen. If those deteriorate while the stock is being promoted heavily, the risk may be rising. This is why investors need a framework before the emotion arrives. Because once a stock starts moving, the brain changes. If it falls, fear takes over. If it rises, greed takes over. Both can destroy judgment. The best investors make their decisions before the market forces them to react. They know what they own. They know why they own it. They know what would change their mind. And they know that no single stock is worth abandoning risk management. That is especially true in a market environment like this, because we are not investing in a calm world. We are investing in a world with massive fiscal deficits, rising geopolitical risk, expensive mega-cap technology, stretched private valuations, and a growing need for strategic infrastructure. The crowd is still focused on the same familiar winners, but under the surface, capital is beginning to ask a different question. What companies benefit if the next decade is not about convenience but resilience? What companies benefit if defense spending remains elevated? What companies benefit if space becomes a critical operating domain? What companies benefit if governments need autonomous systems quickly? What companies benefit if private market giants remain locked away, forcing public investors to search for alternative exposure? Redwire may be one answer. Not the only answer, not a guaranteed answer, but a serious candidate. And that is enough to deserve attention. The important thing is to separate the thesis from the price. A $17 stock can double and still be risky. It can fall 40% and still have a long-term thesis. It can look cheap and be expensive. It can look expensive and still be early. The share price is only the visible layer. The deeper layer is whether the business is moving into a larger opportunity set while the market is still using an outdated framework. That is where re-ratings come from. The market does not wake up one day and politely announce that a company belongs in a new category. It happens gradually, then suddenly. A few contract wins, a stronger quarter, a defense budget headline, an acquisition that starts making sense, a competitor's valuation that forces comparison, a private market event that pulls attention into the public names. Then the same stock people ignored begins appearing on watch lists. Then analysts revise models. Then institutions begin asking questions. Then retail investors discover the story after the first major move has already happened. That is the pattern. It does not always play out, but when it does, it feels obvious in hindsight. Everyone says they saw it coming. Few actually did the work when the story was still uncomfortable. And that is the lesson here. The market does not pay investors for recognizing obvious things. It pays them for seeing what is becoming obvious before the price fully reflects it. But there is a cost. You have to tolerate uncertainty. You have to tolerate being early. You have to tolerate looking wrong. And you have to accept that sometimes you will be wrong. This is not financial advice. It is a framework for understanding the risks, incentives, and signals the market may be ignoring. For investors watching this space, the next step is not to chase emotion. It is to monitor evidence. Does the company keep growing revenue without destroying margins? Does backlog convert into cash? Does the defense autonomy strategy strengthen the business or simply add complexity? Does management control dilution? Does the market begin valuing the company as strategic infrastructure rather than speculative space exposure? Those are the questions, not whether the stock is popular today, Not whether someone online is excited, not whether the price looks low. The question is whether the pressure beneath the surface is building in the right direction. Because in markets, the biggest moves often begin before the crowd has a clean explanation. They begin when a few investors notice that the old label no longer fits. They begin when a company quietly moves from optionality to necessity. They begin when the world changes faster than the market's model. And if this thesis is right, the story is not really about a $17 stock. It is about a strategic shift hiding inside a number that still looks small enough for most investors to ignore. That is usually where the future starts whispering before the market starts shouting.